I need to tell you something that will probably cost me friends in the real estate industry. I have identified 7 specific real estate markets in the United States that are going to crash by 50% or more in 2026. Not a correction, not a softening, a crash, a collapse that will wipe out billions of dollars in wealth and destroy the financial lives of everyone who bought at the peak. And I am not guessing, I am not speculating. I am analyzing the same data patterns that I saw in 2005 and 2006 before the last housing crash. The exact same patterns. Unsustainable price growth disconnected from incomes. Speculation driving demand instead of real end users. Loose lending standards, enabling people to buy homes they cannot afford. Massive oversupply in the pipeline. And an economy that is about to weaken dramatically. Every single warning sign is flashing red in these 7 markets. And the people who live there, the people who own real estate there, they have no idea what is coming. They think prices will keep rising forever. They think their home is a guaranteed investment. They think real estate never goes down. They are wrong, catastrophically wrong. And when the crash comes, they are going to lose everything. Today, I am going to walk you through each of these 7 markets. I am going to show you the data. I am going to explain exactly why these markets are going to crash. I am going to tell you the specific catalyst that will trigger the collapse. And I am going to give you a timeline. Because this is not some distant future possibility. This is happening now. The crash has already started in some of these markets. And by the end of 2026, all 7 will be down 50% or more from their peaks. So if you live in one of these markets, if you own property in one of these markets, if you are thinking about buying in one of these markets, you need to pay very close attention to what I am about to tell you. Because the decisions you make over the next 12 months will determine whether you preserve your wealth or watch it evaporate. Let me take you back to 2005. I was running Scion Capital and I was obsessed with the housing market. I was reading everything I could find about mortgages, about lending practices, about housing prices. And I was traveling. I was visiting housing developments in California, in Florida, in Arizona, in Nevada. I wanted to see with my own eyes what was happening. And what I saw terrified me. In the Inland Empire of California, east of Los Angeles, I visited new housing developments where builders were putting up hundreds of homes, and the sales offices were packed. People were camping out overnight to be first in line to buy. They were buying multiple properties. Investors were snapping up condos before they were even built, planning to flip them for a profit. Nobody was buying homes to live in. They were buying homes as investments, as speculations, as lottery tickets. I talked to the salespeople. I asked them who was buying. They told me stories about strawberry pickers earning $25,000 per year, somehow qualifying for $600,000 mortgages. About people with no jobs buying homes with stated income loans where they just wrote down whatever income they wanted and nobody verified it. About adjustable rate mortgages with teaser rates of 2% that would reset to 8 or 9% in a few years. And I asked them what happens when these mortgages reset, when the payments triple, when these borrowers cannot afford them. And they looked at me like I was crazy. They said housing prices always go up. People can just refinance or sell at a profit. There is no risk. And I knew they were wrong. I knew that when you have strawberry pickers buying $600,000 homes with adjustable rate mortgages, you do not have a sustainable housing market. You have a bubble. And bubbles always pop. So I started buying credit default swaps on mortgage-backed securities. I was betting that the housing market would crash and that the securities backed by these garbage mortgages would fail. And for 2 years, I looked like an idiot. Housing prices kept rising. My swaps lost money. My investors questioned my judgment, but I had done the work. I had seen the data. I knew what was coming. The crash started in 2007. Housing prices peaked and began falling. Adjustable rate mortgages reset. Borrowers defaulted. Foreclosures spiked. And the mortgage-backed securities I had bet against collapsed in value. My credit default swaps went from being worth almost nothing to being worth hundreds of millions of dollars. Scion Capital made $490 million on that trade. But more importantly, I was right. I had identified a bubble. I had predicted its collapse. And I had positioned myself to profit. And now, 18 years later, I am seeing the exact same patterns in specific real estate markets across the country. Not everywhere, The national housing market is not going to crash 50%. But specific markets, markets that saw explosive price growth during the pandemic, markets that attracted massive amounts of speculation, markets with fundamental economic weaknesses, these markets are going to get absolutely destroyed. And I have identified 7 of them. 7 markets where all of the warning signs are present, where prices have become completely disconnected from local incomes, where speculation drove prices to unsustainable levels, where massive oversupply is about to hit the market, and where the local economies are too weak to support current prices. These 7 markets are going to crash, and crash hard, 50% or more, and it is going to happen in 2026. The first market is Austin, Texas. Austin was the hottest real estate market in America during the pandemic. From 2020 to 2022, median home prices in Austin rose from $400,000 to over $650,000. That is a 62% increase in 2 years. Insane. And it was driven entirely by speculation and migration. During the pandemic, technology workers fled San Francisco and New York and moved to Austin. They could work remotely. They wanted lower taxes. They wanted more space. And they brought their California salaries with them. A software engineer earning $200,000 per year in San Francisco could buy a mansion in Austin for what a small condo cost in California. So they piled in. Demand exploded. Prices soared. But here's the problem. That migration has stopped. The tech companies that drove it have done massive layoffs. Meta laid off tens of thousands of workers. Amazon laid off tens of thousands. Google, Microsoft, all of them cutting headcount. The workers who moved to Austin during the pandemic, many of them no longer have jobs. Or they have been forced to return to the office. Remote work is ending. Companies are mandating return to office. So the people who moved to Austin are now moving back. Or they are stuck in Austin with a mortgage they cannot afford. At the same time, supply has exploded. Builders started thousands of projects during the boom. Those projects are completing now. Austin has more new housing units coming online than almost any city in America. And all of that supply is hitting a market where demand has collapsed. The result? Inventory has tripled over the past year. Homes are sitting on the market for months. Builders are cutting prices 10, 15, 20%, trying to move inventory. And this is just the beginning. Austin has another fundamental problem. The local economy is not strong enough to support these prices. Yes, Austin has tech companies, but most of the jobs are lower-paying service jobs. The median household income in Austin is about $80,000. At current prices, the median home costs over $600,000. That is a ratio of 7.5 to 1. Historically, sustainable markets have price-to-income ratios of 3 or 4 to 1. 7.5 is bubble territory. For a household earning $80,000 to afford a $600,000 home, they need to spend over 50% of their gross income on housing. That is not sustainable. People cannot afford it. So demand is going to keep falling, inventory is going to keep rising, and prices are going to crash. I expect Austin home prices to fall from $650,000 to $325,000 or lower, a 50% decline. By the end of 2026, Austin will be one of the worst performing housing markets in the country. The second market is Phoenix, Arizona. Phoenix is another pandemic boomtown that is about to bust spectacularly. Home prices in Phoenix went from $350,000 in 2020 to over $575,000 in 2022, a 64% increase, and just like Austin, it was driven by migration and speculation. Californians fled high taxes and moved to Arizona. Investors bought properties planning to rent them out or flip them. Builders put up thousands of new homes and condos, and now it is all unwinding. The migration has stopped. California is not losing population anymore. In fact, people are moving back because Arizona politics has gotten too extreme and the heat is unbearable. Phoenix hit 118 degrees last summer. You cannot go outside for months. The electric bills to keep your house cool are $500, $600, $700 per month. People are realizing that living in Phoenix is miserable, and they are leaving. At the same time, Phoenix has a massive oversupply problem. Builders went crazy during the pandemic. They built entire new communities, tens of thousands of units, and all of that supply is completing now. Phoenix has over 40,000 new housing units hitting the market over the next 18 months. 40,000, in a market where demand has collapsed. Builders are already panicking. They are offering huge incentives, free upgrades, seller-paid closing costs, rate buy-downs. Some are cutting prices by 20 or 30%, and it is still not working. Homes are sitting unsold. And here is where it gets really bad. Phoenix is heavily dependent on investor buyers. Over 30% of home purchases in Phoenix during the pandemic were investors. People buying properties to rent out, but the rental math does not work anymore. Home prices went up 60%, but rents only went up 25%. So investors are losing money every month. The mortgage payment is higher than the rent they can collect. And when investors realize they are losing money, they sell. And when they all try to sell at the same time, prices crash. This is already happening. Investor sales are spiking, inventory is exploding, and prices are starting to fall. I expect Phoenix home prices to fall from $575,000 to under $300,000. More than 50%. Phoenix is going to be a disaster. The third market is Boise, Idaho. Boise had one of the most extreme price run-ups during the pandemic. Home prices went from $400,000 to over $600,000, a 50% increase in less than 2 years. And it was entirely driven by Californians moving to Idaho. They sold their homes in California for $2 million and bought in Boise for $600,000. They thought they were getting a bargain. But Boise is a small market. The entire metro area has less than 800,000 people. When a few thousand wealthy Californians move in and start buying everything in sight, prices explode. But that created a massive affordability problem for locals. The median household income in Boise is about $65,000. At a median home price of $600,000, locals cannot afford to buy. They have been priced out of their own city, and the Californians who moved there are realizing that Boise is not what they thought. It is cold, it is isolated, there is nothing to do. The schools are not great. The culture is very conservative, and many of them want to leave. At the same time, Boise has no economic base to support these prices. It is not a tech hub. It is not a financial center. The biggest employers are healthcare and government, low-paying jobs. There is no reason for homes in Boise to cost $600,000. It makes no sense, and now the market is correcting. Inventory has quadrupled. Homes that used to sell in a week are sitting on the market for 6 months. Prices are already down 15% from the peak, and they are going to fall much further. I expect Boise to crash from $600,000 to $300,000 or less. The Californians who bought at the peak are going to lose half their money, and many of them will walk away and move back to California. Boise is going to be a case study in what happens when a small market gets overwhelmed by speculation. The fourth market is Las Vegas, Nevada. Las Vegas is a market I have studied extensively because it always leads the country in booms and busts. Las Vegas crashed harder than anywhere else in 2008. Prices fell 70%, and it is going to crash again. Home prices in Las Vegas went from $325,000 in 2020 to over $500,000 in 2022, over 50% in 2 years. And it was driven by the same factors: migration, speculation, cheap money. But Las Vegas has fundamental problems that make it extremely vulnerable. First, the economy is entirely dependent on tourism and gambling. When the economy weakens, tourism falls, casinos suffer, jobs disappear. Las Vegas has the most cyclical economy of any major city in America, and we are heading into a recession. Second, wages in Las Vegas are low. Median household income is about $65,000. Most jobs are in hospitality. Dealers, waiters, hotel workers, these are not high-paying jobs. At current prices, locals cannot afford to buy. Third, Las Vegas has massive oversupply. Builders have been putting up homes and condos at a frantic pace. And now all of that supply is hitting the market at exactly the wrong time. Fourth, Las Vegas has no water. Lake Mead is at record low levels. Water restrictions are coming. At some point, Las Vegas will not be able to support more growth because there is literally no water. This is an existential crisis that nobody is talking about. And fifth, investors own a huge percentage of the housing stock in Las Vegas. Over 35% of homes are owned by investors who rent them out. When the recession hits, when tourism falls, when people stop coming to Vegas, rental demand will collapse. Investors will try to sell, and prices will crash. I expect Las Vegas home prices to fall from $500,000 to $250,000 or lower. A 50% crash. And it could be worse. If the water crisis accelerates, if Lake Mead drops to critical levels, Las Vegas could see a 70 or 80% crash like it did in 2008. The fifth market is Miami, Florida. Miami had an absolutely insane price run-up during the pandemic. Luxury condos that sold for $2 million in 2019 were selling for $4 million in 2022. Waterfront homes went from $5 million to $12 million. The entire market doubled in 3 years. Why? Because wealthy people from New York and California fled high-tax states and moved to Florida. Hedge fund managers, private equity executives, tech entrepreneurs, they all relocated to Miami for the zero state income tax, and they brought their money with them. They bought condos, they bought mansions, they drove prices through the roof. But this created a two-tier market. The luxury segment exploded while the middle and lower-end markets became completely unaffordable for locals. And now the migration is slowing. The people who are going to move to Florida have already moved. There are no more buyers at these prices. At the same time, supply is exploding. Developers started dozens of luxury condo towers during the boom. Those towers are completing now. Thousands of units are hitting the market, and many of them are not selling. Developers are sitting on unsold inventory. They are cutting prices. They are offering incentives. But there are not enough buyers. Miami also has fundamental risks that most people ignore. Climate risk, sea level rise, hurricane risk. Insurance costs have exploded. Some properties are essentially uninsurable. And Florida's political environment is becoming a problem. The extreme policies, the culture wars, the erosion of freedoms. Some people are starting to question whether they want to live there. I expect Miami luxury real estate to crash 50% or more. Condos that sold for $4 million will trade for $2 million or less. Waterfront homes that hit $15 million will fall to $7 or $8 million. The middle and lower end markets in Miami will fall even more because they are even more overvalued relative to local incomes. Miami is going to be a disaster for anyone who bought at the peak. The sixth market is Raleigh-Durham, North Carolina. This one surprises people because Raleigh is considered a strong market with good economic fundamentals. And that was true historically. But during the pandemic, Raleigh saw explosive price growth that disconnected prices from fundamentals. Home prices went from $350,000 to over $550,000, a 57% increase. And it was driven by people relocating from expensive northern cities. They were attracted by lower costs, good weather, Research Triangle jobs. But here is the problem. Most of the people who moved to Raleigh during the pandemic were remote workers, tech workers, finance workers, consultants, and now those companies are ending remote work. They are mandating return to office. So the workers who moved to Raleigh are being told to come back to New York or Boston or wherever the company is headquartered. Or they are getting laid off because companies do not need as many remote workers anymore. This is creating a wave of forced selling. People who bought homes in Raleigh are now stuck. They have to sell and move back, or they are unemployed and cannot afford the mortgage. At the same time, Raleigh has oversupply. Builders went crazy, putting up new subdivisions. Thousands of homes and townhouses are completing now. And the local economy is not strong enough to absorb all of this supply. Yes, Raleigh has some good employers. Universities, hospitals, some tech companies, but median household income is only about $75,000. At current prices, locals cannot afford to buy. The market is entirely dependent on people moving in from other states, and that has stopped. I expect Raleigh home prices to fall from $550,000 to $300,000 or less, a 45 to 50% decline. Raleigh is going to correct back to levels that make sense based on local incomes. The seventh market is Nashville, Tennessee. Nashville has been the darling of real estate investors for the past decade. It was cheap, it was growing, it had a strong economy. Everyone wanted to move there. And during the pandemic, prices went parabolic. From $350,000 to over $575,000 in 2 years, a 64% increase, and it was driven by migration and speculation. People from California and New York moved to Nashville for lower taxes and lower costs. Investors bought properties to turn into short-term rentals for the booming tourism industry. Builders put up thousands of units, and everyone assumed the growth would continue forever. But the fundamentals do not support current prices. The median household income in Nashville is about $65,000. At a median home price of $575,000, that is almost a 9-to-1 ratio. Locals cannot afford to buy. The market is entirely dependent on people moving in from other states, and that migration is slowing dramatically. At the same time, Nashville has oversupply. Builders have completed thousands of new units. Many of them are sitting empty, and the short-term rental market is saturated. Investors who bought properties to rent on Airbnb are finding that there are too many listings and not enough tourists. Occupancy rates have fallen. Nightly rates have fallen. Many investors are losing money, and when they try to sell, they are finding no buyers at current prices. I expect Nashville home prices to fall from $575,000 to under $300,000, 50% or more. Nashville was a great market 10 years ago, but at current prices, it is wildly overvalued. Now let me explain the common patterns across all 7 of these markets, because these are not random. These are specific characteristics that identify which markets are most vulnerable. First, all 7 markets saw price increases of 50% or more in less than 3 years. This is not normal. This is not sustainable. This is speculation. In a healthy market, home prices rise roughly in line with incomes, maybe 3 to 5% per year. When you see prices rising 20, 30, 40% per year, that is a bubble. Second, all 7 markets have price-to-income ratios that are double or triple the historical average. When the median home costs 7, 8, 9 times the median household income, locals cannot afford to buy. The market becomes dependent on wealthy people moving in from other states, and when that migration stops, the market collapses. Third, all 7 markets experienced massive migration during the pandemic that has now stopped or reversed. The people who were going to move have already moved. There are no more buyers coming. Fourth, all 7 markets have massive oversupply. Builders started thousands of projects during the boom. Those projects are completing now, and all of that supply is hitting markets where demand has collapsed. Fifth, all 7 markets have high investor ownership. Investors bought properties during the pandemic, planning to rent them out or flip them, but the math does not work anymore. Investors are losing money, and when they sell, prices crash. And sixth, all 7 markets are vulnerable to economic weakness. They are dependent on tech jobs, or tourism, or migration from wealthy states. When the economy weakens, when tech companies lay off workers, when tourism falls, these markets get hit hard. Let me walk you through the timeline of how this crash will unfold. We are already in the early stages. In all 7 of these markets, inventory has been rising sharply over the past 12 months. Homes are sitting on the market longer. Days on market have doubled or tripled. Sellers are starting to cut prices. In some markets like Austin and Phoenix, prices are already down 10 to 15% from the peak. Over the next 6 months, from now through mid-2025, the following will happen. More supply will hit the market as builder projects complete. Investor selling will accelerate as investors realize they are losing money and want to get out. The economy will weaken, unemployment will rise, and buyer demand will fall further. Price cuts will become more aggressive. Sellers who need to sell will drop prices 20, 30% to attract buyers. Then in the second half of 2025 and into 2026, the crash will accelerate. Foreclosures will start to rise. People who bought at the peak with low down payments and high debt-to-income ratios will default when they lose jobs or face financial hardship. Banks will foreclose and dump properties on the market at fire sale prices. This will drive prices down further. More homeowners will go underwater, owing more than their homes are worth. Some will strategically default, walking away from homes that are worth less than the mortgage. This will create a vicious cycle. More supply, falling prices, more foreclosures, more supply, lower prices. By the end of 2026, I expect all 7 of these markets to be down 45 to 60% from their peaks. Some will be down even more. Now let me address the question everyone asks. What about the rest of the country? Will all housing markets crash? And the answer is no. This is not 2008. In 2008, the entire country crashed because the problem was systemic. Subprime lending was everywhere. Fraud was everywhere. When the bubble popped, it took down the entire national market. This time is different. The problem is not systemic. It is concentrated in specific markets that saw extreme speculation during the pandemic. Markets like Austin, Phoenix, Boise, Las Vegas, Miami, Raleigh, Nashville. These markets are going to crash hard, but other markets will be fine. Markets with strong local economies, markets where price growth was modest, markets where prices are still reasonable relative to incomes. Places like the Midwest, parts of the Northeast, some secondary southern cities. These markets might see small declines of 5 or 10%, but they are not going to crash. So this is a tale of 2 countries. The pandemic boom markets are going to get destroyed. The stable, fundamentally sound markets will be fine. Let me also talk about what you should do if you live in or own property in one of these 7 markets. If you bought recently in the past 2 or 3 years, you need to seriously consider selling now. Take whatever loss you have to take and get out before it gets much worse. Yes, you might lose 10 or 20% by selling now, but if you hold and wait, you will lose 50%. Sell now while there are still some buyers. If you bought before the pandemic, if you have significant equity, you also need to consider selling. Lock in your gains. Take your profits. You can always buy back in 2 or 3 years when prices are 50% lower. If you are underwater, if you owe more than your home is worth, you have a harder decision. You can try to sell short, where the bank agrees to accept less than the mortgage balance. Or you can strategically default and walk away. Or you can hold and hope. But understand that if you hold, you could be underwater for a decade. It took 10 years for prices to recover after the 2008 crash. Are you willing to wait that long? If you are thinking about buying in one of these markets, do not do it. Wait. Prices are going to fall 50%. Why would you buy now? Wait until the crash has played out. Wait until prices have fallen. Wait until the market has stabilized. Then you can buy at prices that actually make sense. Let me share some lessons from the last housing crash that apply now. First, bubbles always pop. Always. When prices become disconnected from fundamentals, when speculation drives the market, when everyone believes prices will rise forever, that is when the crash is coming. Do not convince yourself that this time is different. It never is. Second, the crash happens faster than you expect. Housing markets can stay irrational for a long time, but when they turn quickly. Prices that took 3 years to rise can fall 50% in 18 months. Do not wait for obvious signs. By the time everyone knows the crash is happening, it is too late to get out. Third, forced selling accelerates the decline. When homeowners go underwater, when investors lose money, when foreclosures spike, the selling becomes forced. People have to sell regardless of price. And when forced sellers dominate the market, prices collapse. Fourth, government intervention does not prevent the crash. In 2008, the government tried everything. Rate cuts, bailouts, loan modification programs, none of it stopped the crash. Prices fell 50% nationally despite massive intervention. Do not count on the government to save you. And fifth, the people who profit from crashes are the ones who see it coming and position themselves ahead of time. I made hundreds of millions in 2008 because I shorted the housing market before the crash. The people who profit this time will be the ones who sell now and buy back in 2 years at 50% lower prices. Let me also address some counterarguments. People will say that housing is different now, that lending standards are better, that we do not have subprime loans and stated income loans like we did in 2008. And that is partly true. Lending standards are better than they were at the absolute worst of the mid-2000s. But they are not good. Debt-to-income ratios of 50% are still too high. Down payments of 3.5% are still too low. Adjustable rate mortgages are still risky. And when the economy weakens, even prime borrowers will default if they lose their jobs. People will say that there is a housing shortage, that we have not built enough homes. That limited supply will support prices. But this argument ignores affordability. It does not matter if supply is limited, if nobody can afford to buy. And in these 7 markets, supply is not limited. Supply is exploding. Thousands of new units are hitting the market. People will say that millennials need housing. That demographic demand will support the market. But millennials cannot afford current prices. At current prices and current interest rates, millennials are priced out. They will wait for prices to fall, or they will keep renting. People will say that these markets have strong economies and good job growth. But job growth has already turned negative in tech. Layoffs are accelerating. And when the recession hits, even the strong markets will weaken. Let me give you some historical perspective. Every housing bubble in American history has ended the same way. Prices rise to unsustainable levels driven by speculation and easy credit. Affordability collapses. Demand falls. Supply rises. Prices start declining. This triggers foreclosures and forced selling. Prices accelerate downward. Eventually, prices fall enough to restore affordability. Demand returns, the market stabilizes, and the recovery begins. This cycle has played out over and over. The Florida land boom of the 1920s, prices went parabolic and then crashed. The housing boom and bust of the late 1980s. Prices in California and the Northeast soared and then collapsed. The nationwide housing bubble of the 2000s. Prices doubled and then fell 50%. The pattern never changes. And it is playing out again now in these 7 markets. The bubble has already formed. Prices have already soared to unsustainable levels, and now the collapse is beginning. The only question is whether you will protect yourself or be one of the victims. I want to be very clear about my motivation for sharing this analysis. I am not trying to cause a panic. I am not trying to talk down the housing market. I am analyzing data. I am identifying patterns. I am following the mathematics. And the mathematics in these 7 markets are screaming that a crash is coming. The price-to-income ratios are unsustainable. The speculation was extreme. The oversupply is massive. The economic fundamentals are weak. And all of the warning signs are present. I was right about the housing market in 2005 and 2006. I saw the bubble when everyone else was celebrating rising prices. I positioned myself to profit. And I am seeing the same patterns now, not in the entire national market, but in these 7 specific markets: Austin, Phoenix, Boise, Las Vegas, Miami, Raleigh, Nashville. These markets are going to crash 50% or more in 2026. And if you own property in these markets, if you live in these markets, if you are thinking about buying in these markets, you need to understand what is coming. You need to protect yourself. Because the crash is not a possibility, it is not a theory. It is a mathematical certainty. The numbers do not lie. The patterns do not lie. And the outcome is inevitable. Prices that are 8 or 9 times local incomes cannot be sustained. Speculation cannot continue forever. Oversupply eventually overwhelms demand. And when these forces collide, prices crash. That is what happened in 2008. That is what is going to happen in these 7 markets in 2026. The clock is ticking. The window to protect yourself is closing. Make your decisions now, before it is too late,